All right. So hello, everybody. Good afternoon. My name is Natalie with CalCoast Credit Union, and I work in the CR department. As you guys may know, CalCoast Credit Union is the longest serving financial institution here in San Diego. The credit union was started by teachers in 1929, and since the beginning, our vision has been to foster a culture of service and commitment to our community. We are passionate about providing valuable resources and tools to the members to help achieve financial prosperity. To that end, I'm excited to welcome you guys today to the home buying process webinar. We have lots of these financial wellness webinars, and I'm excited to share with you guys. Before we dive in, I'd like to mention that everyone's going to be placed on mute. However, if you do have questions, please feel free to utilize the question box and or the comments. We will be going over them periodically throughout the presentation. I will be doing this presentation today with Steve Volley and our Business Development Officer. That will be facilitating. If by chance you prefer to ask your question, we ask that we don't have any spoken questions or raised hands, just because it takes up too much time and it'll be easier to get through all of our information if we do it at the end of each slide. Last but not least, we will be recording this session. So if you'd like to go back and review any of the information that will be presented today, you can do so by visiting our YouTube channel. We have a specific channel dedicated to the city of San Diego, so be sure to check that out. I can leave the link in the chat later during the webinar. All right, I know we have a lot of important and valuable information to cover today, so let's get started. I am pleased to introduce my colleague, Steve Volley, who is today's presenter. Steve is a Senior Vice President overseeing the Real Estate Lending Department. He has been with CalCoast for the past 6 years and has been in the real estate and lending industry for his entire career, spanning 37 years with credit unions and his own mortgage brokerage. Steve has assisted hundreds of members in purchasing their first homes, as well as investment properties and vacation rentals. He's well-versed in all aspects of a purchase transaction and has works to avoid surprises in the approval process that may delay closings. Steve, the floor is yours.
Thank you very much. Good morning or good afternoon, I guess, at this point to everybody. Just wanted to welcome everybody to this seminar. It's a very high-level review of how the buying process works, and it should give you a good understanding of the basics that go into it. It's not a strategy on how to buy houses. It's not a strategy on how to structure your financing. And we will go over just the very basics at a high level, and your questions are welcomed. What we typically will do is, if you can add those to the chat once we get done with every screen, and I'll add my screen right now, I'll share my screen right now. I will be more than happy to address all the questions. My goal is to make sure that you come away with a better knowledge of what goes into buying a house. You know, when you see a sign that goes up in front of a home, what does that mean? So without further ado, let me go into the basics that we're going to cover today. If my mouse will. So my topics for discussion, and again, a very high level. First of all, we're going to talk about why rent versus own. You know, why even consider buying a house? What are the pros and cons associated with both? While renting may seem like it's a con for a lot of folks, there's a lot of value depending on what folks are doing, as we'll explore. And then owning, what are the additional benefits of owning, but what are all the other things that go with actually owning a property? And then we're going to talk about basically the 5 steps that I find are most advantageous for a successful purchase. And those will be developing a housing budget based on what you can afford, and I'll recommend getting pre-approved. Knowing what you can buy, and we'll talk about that, is great before you move on to the next step. Choosing a realtor, you know, you need a professional to help you structure an offer and get you into the property. We'll talk about the basics of that. And then looking at properties. I have some strategies that I employed on my own when I went and bought a house. And full disclosure, I've owned 2 homes, and I've gone through this process twice, even though I knew the whole lending aspect of it. I knew all the lending process. It is a daunting task because you're forced to rely on many parties to complete the transaction. Then we'll talk about what goes into making an offer, and finally, after the offer, what do you do to actually get the loan closed? What, for example, we do in my department, when the borrower comes to us with the purchase officer, what's involved, purchase offer, what is involved then with processing the loan and getting appraisal and going through all those steps. So with that in mind, let's proceed. I'll assume there's no questions here. We may end up getting questions after that, but I'll just double check. Natalie, do we have anything just on this?
I think you're good to go as of right now.
Thank you. All right, moving on. So renting versus buying, okay? There's renting, oh, I don't want to rent. But there are some benefits to renting versus owning. And these are some of the things we need to think about relative to where you are and where you may be going professionally. One of the things is being in a remote society now that post-COVID, with a lot of jobs, I'm not sure the city has as many that you can work remotely, but if you were advancing career-wise and your advancement was potentially taking you out of the area, one of the nice things about renting is you have a flexibility to move. You can go and pretty much finish your lease. You may end up having to break a lease, but you're not tied to a property, and you're highly mobile if you need to move around. The other option is that by renting, you may have other advantages that maybe you're not putting all your money into a property in the form of a down payment and closing costs that you may, although with the stock market doing what it's doing, you may have alternative investments. And so that the cost of renting may actually save you some money that you can then invest elsewhere. The other thing is actually renting is probably, although it's relatively expensive in the San Diego area, it's a lower cost to obtain housing. You don't need a down payment. You don't need closing costs. You just need typically first and last month's rent and a security deposit. Granted, that's a fair amount of money, but relative to the cost of buying a house, it's substantially lower. So those are some of the advantages. The disadvantages, clearly, you don't have control over your monthly payment. So if you have a landlord that regularly raises their rents based on the market, then you're constantly looking at a hike from year to year. And in many cases, you don't always get the same increase in income. So you have instability in controlling your housing costs. The other thing is you move into a property and you may want to alter it for your use, turn part of the house into, say, a workshop or something. And if you don't own it, your landlord may not allow you to alter it significantly or change the color of the walls or structurally change that. Whereas if you were an owner, you could do that very easily. Additionally is when you make a payment in rent every month, as opposed to a housing payment, you're not putting it towards any equity. As a homeowner, when you make a monthly payment, part of that payment is actually going to build equity in the property that you buy. So depending on where you are, as a homeowner, I highly recommend it. It's a great investment. But renting, there are benefits associated with that. And those are some of the things that you have to look at in evaluating, as we'll talk later. Renting versus owning, you may actually find that buying is more expensive overall than being able to rent. So that may be one of the greatest barriers to getting into ownership. So I'll stop there on this topic and see if there's any questions associated with that.
No questions yet.
Okay, we'll move on. Fairly self-explanatory. And now the advantages of buying. Of course, that's why we're all here. We want to find a way to buy a property in San Diego and become a homeowner and build equity and lock in that low monthly payment, which is one of the things that you can do with a when you own a property. Is by getting into a property, you can control based on financing how much your monthly payment is. Certain things may go up when you buy a property, like your property taxes can go up a little bit, your homeowner's insurance can go up a little bit, but that core payment that you're paying to finance the property, depending on which type of loan you get, you can lock in for a period of time and know with a great deal of certainty what your housing costs will be for the next 5-7 years. Whereas if you're renting, again, if you have the good landlord that's willing to keep your rent low because you're a good paying tenant, versus the one that raises it. Those are the challenges in the renting world. The other thing is now you're making a housing payment every month. Not only are you making a payment for where you live and what you own, but each payment goes to pay down the mortgage, which builds equity in the property. So your payment is not going out the door. It's going towards the value or the equity that's building in the property. Additionally, depending on your tax bracket, you're able to write off the interest and the property taxes associated with it. So at the end of the year, even though you've maybe had a higher payment based on principal, interest, taxes, and insurance, your after tax payment, if you get money back from Uncle Sam, it may offset some of the higher cost, and your after tax payment for owning a house could be, although it may be higher than renting, it's less than what you're actually paying because you now have the ability to write off the interest and the property taxes you pay on the property. Now, some of the disadvantages, clearly having the down payment and closing costs. So depending on what you have available that you've saved or that you can access through 401ks or gift funds or anything else, it's a substantial amount of money that you have to come up with, 3.5%, 5%. We do have some 0% options, but there is money. You can't typically buy a house without any money into the transaction. And so one of the things that I'll talk about later is knowing what your options are for buying, what that commitment is as far as the money, and it gives you a good comparison of is renting going to be a better option for me in this area versus buying. Of course, when you do buy, you are less mobile. You may end up taking a job in another city, and now you have a house. So the options are: can I sell it? Can I rent it out? It just adds a lot of issues. Whereas if you were renting a property, you can basically turn back in the keys. And if it's a rental month to month, you're great. If it's a rent that you need to break, maybe you can sublet it. But the other side of it is then selling it. If it hasn't appreciated enough, you may actually have to pay some cost to sell the property above and beyond what you sell it for. Although the market to date has been very, very high. If you're getting into a property, I would anticipate and advise everyone that you're looking at least owning and living in the property for a period of 5 to 7 years for it to make the most sense and have the least amount of uncertainty with this investment. Now, the other disadvantage of buying a house in many cases, you're going to have additional expenses of upkeep, maintenance. If you live in a condominium, you may have some of the household fixtures or features taken care of by the association. But if you if you have appliances that go out or you need plumbing work or whatnot, that's all at your expense. So one of the downfalls of owning a property is maintaining it, the upkeep, and also taking care of any of the issues that arrive from the basic plumbing, electrical, appliances. That's all on you. That's all your property now. So you may, my personal experience, suddenly Home Depot looked much more attractive when I was a homeowner, because all of the things that I can now do with the property became an occupational. You're walking in there. I wanted to spend money to fix up my property. So anyway, those are the basics of that, and I'm sure there's plenty more that we can cover. But the bottom line is, you do get some benefits of home ownership associated with taxes, as well as fixing in your payment, the cost to get in, less mobile, and the ongoing cost of maintaining the property. So at this point, I'll pause, Natalie, and see if we have any questions.
Thank you, Steve. We have a few questions, I think 3 right now.
Okay.
Robert Scheid asks, with interest rates going up, will demand for housing go down and help prices go down a bit?
Great question. And my crystal ball says maybe. There's no easy way to say where that's going. If you're a true economist, in theory, yes, it should slow the cost of housing, because overall, if you have to pay more for housing, the exorbitant increases in values may slow and actually come down because it becomes less affordable for a lot of people. The dynamics going forward will depend, I think, a large part on where interest rates end up. And for now, just rising interest rates will not change it. If we start going towards, say, the recessionary forces that they're talking about, where people are losing their jobs and where demand for housing actually will slump, and folks cannot get into it, where you actually have more people selling, we may see that come down. I do believe we're seeing the frothiness come out of the market, where the above asking prices may be slowing. In some neighborhoods, it hasn't changed at all. In other neighborhoods, it may be trending down a little bit or plateauing. But it's not an easy answer, because we still have a pent-up demand. There's still people that want to buy houses, and right now the supply of houses is about a month. A normal, healthy market has a housing supply of about 3 months. We're starting to see that extend, so that means there's more houses on the market, but we continue to see that the pent-up demand for owning and buying property still exceeds the supply, regardless of where interest rates are going. That imbalance in the market needs to work itself out before higher interest rates are going to have any real effect on that. But in theory, that's why the Fed is raising rates, is to actually make it more difficult to buy, more expensive to buy. And over time, that may balance out, but it may actually flip it the other way. So I will say, I think it will have a slowing effect on the increase in prices. I'm not sure at this point we'll actually see a decrease. At least it's not indicative now, but maybe in 3 months it may be moving that way. So sort of a non-answer answer.
Perfect, thank you. Okay, so Melanie Fontana asked, in a situation such as purchasing a mobile home for which you still have to pay rent on the space in a park, is that kind of worst of both worlds, or are there advantages to it?
No, I can say that that's definitely, there's advantages of getting in. It's a question of controlling your expenses. Now, to be clear, when you buy something like that, that is not considered real estate for anything that the credit union or most residential lenders would do, because you own the home, but you don't own the land that's on it. So that is a totally different type of transaction. But again, if you can buy the mobile home at a fixed cost and finance it, you control a good portion of that payment. The variable then comes in is, what does the space rent go to? And how stable has it been over the previous years? How much do you get associated with that space rent? Do you have other amenities? Do they have a community pool? Do they have other things? Like, is it in a great location? There's all of those go into it. You'd have to evaluate it based on, the alternative, and the biggest variable in that, after the cost of the actual mobile home, is how much does the space rent fluctuate? What's the history of that, and what drives that to increase? If you know that, then you can make a fairly good calculation on what your expenses would be.
Great, thank you for that answer. And then last question, Robert Scheid asks, which pencils out better, 0 down and a few more points, or some money down and lower points?
It depends. Great question. It really depends on what you're getting for your money. So 0 down, we have a great option. If you can fit into the 0 down program, I would take the 0 down and not pay any points, because you're getting the best of both worlds. And for example, and I don't want to get into it too much because it's a specific question, when you pay points, you're basically paying, that's an additional expense to get into a loan. And if you're going to pay, say, I'll just give an example. If you pay 1 point to lower your interest rate, say 0.5%, and without making this too much, if that 0.5% in the interest rate saves you, say, $75 a month, let's say $100. If you're saving $100 a month and it's costing you, again, I'm making this up, it's costing, if you pay points of $4,000, in simple math, it would take you roughly 40 payments to recoup the cost that you're paying up front. So in other words, you've basically paid out money to get a lower rate, and paying that back to yourself, you would have to stay in it past 40 payments before you see the benefit of that money up front. The other side of it is, when you buy the property, do you have enough in reserve in case anything happens to you that you can cover, 3 or 6 months worth of expenses? I'd rather put that money aside. Buying a house is completely different than renting. And if you get into trouble, you want to have a cushion to make sure that you can make the payments. So that's a sort of answer. That would be one that we would look at in detail based on a member's individual financial picture. But I hope that explains just kind of the nuts and bolts. There's an easy calculation to find out where your break even is. And then from there, look at how long then you need to be in the property.
Perfect. Thank you so much, Steve. And then we got one more question from Ruby Baricuatro. Said, with interest rates rising, is this not advantageous as a home buyer? Are you locked into these high interest rates?
Great question. And what I would say is higher interest rates you force you to look at options. And it was common knowledge after 2007, 2008. If you said adjustable rate, everybody ran and said, that just got everybody into trouble. But there are great programs associated with adjustable rates that give you a lower payment up front for a little bit of risk down the road. And I say a little bit of risk. We can tell you your worst case scenario, but if you can get into a rate on an adjustable loan for less than, say, 3% or around 3%, whereas a fixed rate is at 5.5%, you really need to explore your options and look out what the benefits you get with adjustable rates. I, for one, have always had an adjustable rate. I've never had a fixed rate. I'm in the business, so maybe I have an advantage, but I've always chosen a shorter term loan because I've looked at my time horizon in 5 or 7 year increments, where I was 5 years ago, where I'm going to be in 5 years. So there's a great deal of benefits. In the last 2 years, less reason to look at the adjustable rate as opposed to the fixed rates because we were at historical lows. You take that. Now that we're in this type of a market, you can still take advantage of the housing market and get in. In other words, don't put everything on hold, but look at loans that like a lot of lenders have, including Calcos, like a 7-1 ARM or a 5-5. And I can talk about that more in detail, but these loans will get you in for lower or kind of what the 30-year mortgages were, say, in January or December of last year, with an understanding that they can go up after 5 years or after 7 years. And as long as you understand what the worst case is, that worst case may be what the current 30-year fixed rate is now. So there are great alternatives with adjustable rate loans, provided you understand how they work. They're nothing like the loans that were offered that created the housing crisis in 2007, 2008, 2009, because the loans, they used to be, hey, take this loan and you can refinance in 2 years. That's not the strategy I'm talking about. I'm saying take the loan if the interest rate is fixed for 5 or 7 years, understand how it's going to move or how it could change at that adjustment period, and then build for it. But if you can get in and take advantage of it for now, you can be way ahead in 5 or 7 years based on these alternatives. And to give you an idea, say in January, February, and March of this year, 90% of the people that were borrowing from CalCoast on refinances or purchases were fixed rate. Since that time, it's just the opposite. 90% of those folks, or 80%, are now looking at adjustable rate options. And there's some good ones out there with very low interest rates. And again, knowing what your options are, which I'll talk about later, is a great way to then look at a potential buying opportunity.
Great. Thank you, Steve, for that answer. And I think that's all the questions we have for now. So feel free to move on.
Okay, we'll go on to the next part. So we've decided we wanted to buy. Okay, we've made that decision that, hey, I want to control my own destiny. I want to get into that house. I've been looking on Zillow. I've been talking to my parents. They got into homes and they understand that it's a great opportunity. It's the next step in becoming, a complete person, if you will. And I'm not saying that ownership not owning a house doesn't make you complete, but it's a good strategy at the overall investment. But it's also the largest investment that you're going to make. So you need to put a great deal of effort into understanding what what's entailed. So one of the things that I look at very strongly is understanding what you're paying now. Say if you're paying rent versus what a similar payment would be associated with buying a property, or for that matter, when you see a property that's costs $800,000, what does that mean as far as a monthly payment? You have no context of, can I afford that? I'm reminded of the show with the two brothers where these people, they take them into this beautiful home that they want to live in, and they walk them through, and they have the full kitchen, and they have the half bath and this huge staircase, and they want to live in this neighborhood, and then they tell them how much it costs, and they can't buy it because it's too expensive. So setting your expectations based on what you can afford is paramount to being able to buy. And this is the cornerstone or the foundation that you need to look at associated with it. Now, getting pre-approved is if you're ready to go. Short of that is understanding your numbers and knowing what you can afford. And I'm going to change. So we talk about, first of all, when we talk about what you qualify for in the way of a mortgage, we look at your gross monthly income, not what you take home, your credit scores, and then the assets that you have that you're going to go and look that you're going to put down or pay for your closing costs, down payment or closing costs. And so these things, knowing this is really the first place to start. We have many folks that go and make an offer on a property, although less in this market because the realtors want to make sure that you're pre-approved before they do make an offer. They go and they get into a bidding war, and they go up and they go ahead and they purchase a property, and then they come to us and say, hey, I'm ready to buy, and we can't qualify them. So or they say, I can't pay that much. I don't want to pay, I qualify, but I want to pay that much. That's not the time to figure it out. You need to do that ahead of time, and a well-developed plan on this is the way to go. So one of the things that we look at as far as that is really what your maximum payment would be. And this is a little bit out. This is something that came up in the last question. I'm going to stop sharing, and then I will share again. And what I want to show you is in a budget, what you're looking at is your total qualifying payments. And so you got to keep in mind, if you make $5,000 a month and you're paying more than $2,100 a month in rent, you're probably not going to be able to qualify for a home. When we look at qualifying borrowers, we look at the maximum number, and our maximum number is 43% of your gross monthly income. And so when we take into account total qualifying payments, I'm taking into account car payments, student loans, credit cards. It's not the balance, it's the monthly payment that shows up on a credit report. So knowing that number up front, you may not be in a position to buy today because maybe you need to pay off some debt, or you need to work some things out. You refinance a car payment and lower that. Those are all the things that you need to know. But then knowing, depending on what you're making, if it's $4,000, again, these things are crazy. $1,700. If you have a car payment of $500, then you can only put, roughly $1,200 towards a house because your total nut to cover the payment is absorbed by your other debts. So we always say you never want to buy a car before you buy a home because it may limit your ability to get into a property. No problem getting the car after you buy because you're a homeowner, and more than likely you're going to be able to qualify for the card. But when you do it ahead of time, the numbers work against you. So just a little brief on that. I'll just ask, does anybody have any questions on that aspect of the qualification?
No questions right now.
Okay.
However, I did want to recommend that if anybody is looking to see what they can afford, we do have a financial fitness program that can help you determine your credit, cash flow, and what is actually feasible for your monthly payments.
Okay, so let me go back to sharing my screen again.
We actually ended up with a question, if you wouldn't
Oh,
mind.
sure.
Okay, so it says, why is it gross and not net income?
Because the lending gods, when they came up with lending, came up with that. It's kind of unusual, but that's just the way it has been. I've been in this forever. The easy answer is them that have the gold make the rules. And so that's what it is. Now, on some other types of loans, they may look at some net or disposable cash after buying. There's some other calculations, but for most conventional loans, this is the way it is. Now, it's good in qualifying, but as you know, your take-home income is less. So therefore, this payment is actually higher than, because you're not getting all of those dollars. Where it comes into play possibly is that the tax benefits of ownership may offset some of that, so that maybe your tax basis is lower. So maybe it's closer to gross. I don't have any rationale for it. I can just tell you that's the way it's always been in the industry. Okay, so let's say you've, let me go back one. So let's say you've gone through the process, you've figured out everything, you understand that you're a good candidate for buying, and now you go and you want to go to the next process. Well, the best option is to find a good real estate person that knows the area that you're looking to buy, has good understanding. They may have some insights. Now, why are these people valuable? Because they are the ones that will be representing you and making the offer to the seller of the home. And to clarify, how realtors get paid is, if I'm going to sell a house, I will enlist the services of a real estate agent, and we will set up a listing agreement where I will pay the realtor, it's between 2 and 3%, for showing my house and listing it on the MLS and doing all the work with a potential seller. And once the house is sold, they will earn a certain percentage of the home. 3% is typically 2 to 3% in this market. But conversely, when I make this listing agreement, part of the listing agreement is I will also pay an agent that brings a bona fide buyer that completes the transaction 2 or 3% of the sales price. So when you look at engaging a realtor, it doesn't cost you anything. It's part of the transaction, and arguably the commission that is paid to somebody representing you is actually paid out of the seller's proceeds and not something that costs you. So it's built into the overall transaction. So these folks that try and do it without an agent, if you're doing it without an agent, you better be getting at least 3% and you know what you're doing. Most folks that list a home want to work with an agent, and there's tremendous value. They know the marketplace. They know how to write up the California purchase contract. They know what negotiating is. They know what other people have paid for the property. Heck, they may even know the house is going on the market before it does, and they may give you an inside line to buying the property. If they can market you, if you're a family, or have some sway with the say the listing person to say, I have a good buyer for this. Let's see if we can try and work something out before you put it on the market. Unfortunately, in this market still, what they typically do is they list the property and they hope to get as many offers that come in, and then they raise the price up, the counter offers to everybody. But having somebody that knows what the values are to negotiate that is extremely valuable. And the realtor is the one that will present the offer. They'll help you structure what you need, the closing, and what you ultimately want to pay. If there's counter offers, they will work with you on that. They hopefully give you a basis for when, hey, this is maybe too much for the market, or you're overpaying, and here's why. I say they stay objective. You've got to take the emotion out of buying a house. Too many people, when they open the door and they walk in, they immediately move in mentally. Oh, I could put my TV there. This would be perfect for my couch. And realtors kind of keep your feet on the ground and say, hey, you don't do that until you actually get the keys. Let's look at the pros and cons associated with it. And having looked at houses, my first house was my third choice, which ended up being the best choice because I had no clue what I was doing. I was buying for potential of expanding in one property that didn't make sense. The other one had a view, albeit a very small view of the ocean, which I would never take advantage of, and ended up, the third house, and it always is, the one you end up with is the house for you. And by working with a realtor, they help me see the benefits. They also might be able to help you, say, if you're looking at different areas. I recommend trying to look at 3 areas where you potentially want to live and find out what you get for your money in each area relative to the cost. And a realtor is very good at doing that. But they're the ones that will guide you all the way through the process, and the good ones will let you know what to expect every step, the inspection and whatnot. So I highly recommend it. A good realtor is somebody that we love to work with because they're on it. They're helping make sure that all of the commitments are being met, all the deadlines are moving forward, and we're moving towards a good closing date. Anybody have any questions on that?
Yes, we had a few.
Okay.
So Robert Scheid asked, what is MPI?
I'm sorry?
What is MPI?
Um, I think could he possibly mean PMI?
Oh, yes, sorry, PMI.
Yeah, private mortgage insurance. And Robert, I'll get into that just a little bit later. If you have less than 20%, I'll just tell it now. If you have less than 20% down, it doesn't mean you can't buy a house. It just means that you're going to be required to pay some form of mortgage insurance to get into the property. So it is an additional cost, but so some people have a negative view of mortgage insurance, where I would say is, hey, if you don't have 20%, it's the best alternative to it. And mortgage insurance does not protect you. It's not mortgage insurance to protect the buyer. It's mortgage insurance to protect the lender. When the gods came out with lending money to homeowners, it was established that 20% was a reasonable amount of money to put down on a property. And years ago, it used to be the only way you could buy a house with less than 20% down was to get a government-backed loan, an FHA loan. Well, times changed, then the market opened up to where it was no longer just government insured, but we also had private mortgage companies step in to bridge that gap. So what you end up doing is, if you have less than 20% down, what you don't have in down payment, you end up paying as far as insurance premium based on that difference between 20% and the down payment you actually put in. So it is additional cost associated with the property. And one more reason when you're looking at your options to understand what your down payment is and how it affects your monthly costs. Less than 20% mortgage insurance will be required, except we do have one loan that does not require that. And again, I'm not here selling products. I'm here telling you to explore your options and take advantage of the best programs with a thorough review. Any more, Natalie?
Yes, Ruby asked, not sure if this is a realtor question, but what are bidding tips to compete with the flipper investors who have more money? Or is this a hopeless battle?
No, it's a great question. And I had a little stat. There are as many as 30% of the homes today in the marketplace are bought by those folks. So not only are you competing against folks that are home buyers just like you, but you're also competing against investors. And there's no easy answer. If they come in and do an all cash offer, it's really selling, and this is where the broker may come in, selling your story to the seller. Would they want to sell it to somebody that wants to flip the house, or do they want to sell it to, say, a family, or so I've seen where people actually submit an offer that they have been pre-approved, which you have to be if you're competing in that market. It shows that you've done everything except locate a property. So that's the best thing, but also is writing something about you as the buyer. Hey, I'm a, whatever. I've seen great stories where it's a young family. Kids are looking to, play in this neighborhood. They love the white streets, or whatever it is, but selling not only your qualifications as a pre-approved borrower, but also who you are, and personalizing it a little bit. But there's no easy answer. Back to Bob's question earlier, is one of the things that we say with higher interest rates, or that we could see, is maybe these investors and the flippers may slowly get out of the market, because if the appreciation is slowing down, it may be less attractive for them if they're looking to flip to do that. Whereas maybe some of these other buyers that are looking to fix them up and just rent them out, you still have a challenge of competing with them.
Perfect, thank you. And then Ruby had one more question that says, how do you find a good realtor?
Great question. I think you do word of mouth. We do have a realtor program here at the credit union. Again, I'm not selling that, but they come highly touted. They're vetted, and they have years of experience. The key I think you got to look at is two things. Do they know the area you're buying in? How many transactions have they done? Are they going to a good realtor that gives you no time and no I've heard stories where, yeah, I've gone out with the realtor and they keep showing me properties that I'm not interested in. They're not listening to me. They're only, and they're not communicating why. I think word of mouth, if you have folks that have used them before, is a key one, or, actually go and interview a couple based on where you're looking. Anywhere you go, depending on where you live, you may actually get flyers in your neighborhood. Those are folks that are actually working in soliciting for business in the neighborhood. They farm a particular area. That might be a good place to start, but I would also then work with folks that anybody that has worked with a realtor and start there.
Okay, great. Thank you for all those answers. I believe that's all the questions we have right now. Feel free to move on.
Okay, I'm going to move on. And so this is where having a realtor is really valuable, because they'll know based on your qualifications and your desires what to look for. And so they have access to the multiple listing services. And granted, Zillow, Redfin, Realtor.com, all of these services are great. But what we find is that you may be looking at a property that's already in escrow and the website doesn't look at it, or doesn't register that. But what I would recommend that you do, and if you're going on any of these sites, is you're looking at what the amenities are. What's the square footage? How many bedrooms? And it allows you to do a lot from the seat wherever you are from home. And then you can go and then drive neighborhoods and see what you think about that. And the key thing that you got to look at is, okay, affordability. So what does that put you into for your price range? Is it a condominium? Is it a PUD? Is it a single family? Is it a manufactured home? And a manufactured home, to the earlier question, secured to a permanent foundation or a temporary foundation in a park, that typically those are things to look at. The permanent foundation is something that we would do. The temporary foundation in the park is something that becomes a personal property, and there's considerations for that. But I cover that, but it's not something that we lend on currently as far as that goes. But so you need to understand, if it's a condominium, if it's a 52 unit condominium, you're 1/52nd owner of that whole complex. So you need to take into account, what's the HOA fee? Do I have parking? How does the HOA run? Are they very strict on where you have guests park? And can you leave your garage door open? Do they have, very, very tight rules where they're, these HOAs, these folks can get a little bit eager to enforce the rules and tell you what you can and can't do. They love the power, or they would run very tightly. And so that's something you need to think. And HOA fees, some of them include water, some of them don't include water. Some of them include maybe some basic cable, some of them are some connections, some of them don't. Depending on where you're buying, that HOA fee may just go for future expenses. And keep in mind, an HOA fee is to keep up the property and to actually put money aside for future maintenance. If there's grass areas that need to be mowed, or landscaping, things like that, that's what the HOA goes to, or even a pool, those things, but they're covering all of that. So a condominium, you may or may not have a yard that you have to do anything with. And so you basically can turn and go. And so a condominium makes a sense for a lot of people for their lifestyle. But just, you need to understand you're buying into a community, and you need to understand what's associated with the community. A planned unit development looks very much like a single family home, but it may be associated with a group of homes. And it's called a planned unit development, where there may be an association fee to cover landscaping, or maybe there's a shared pool and tennis courts, or maybe some parks or something associated with the homes, other than just the home. So you may, again, a lot of areas, they may have green belts or landscaping coming into the community and leaving the community. that you could pay a fee up to actually having pools and tennis courts, or for that matter, a gated community where you have to go through a gate and access the gate to get through. Those are association fees that are associated with that. Again, I point out that it's an additional cost. It's a fee that we have to actually include in your qualifying ratios. So you may go lower in price because you say, for example, you buy in a condominium, but we also have to take into the account that HOA fee for your overall qualifying. Same with the planned unit development. And then more traditionally in the greater part of San Diego, single family homes where there is no association. You're dictated by the building rules, or the city the rules, or the county rules, wherever you live, and there is less structure to what you do to the property. The other thing in a planned unit, the HOA may tell you what color you can and can't paint in your house. You have to keep to a certain script as far as how you adorn your house from the outside, and then you have to get approval. Single family homes, older homes, older neighborhoods, that doesn't apply. And then lastly, manufactured homes, great value. And then where is it completely done? If it's secured to a permanent foundation, there's additional requirements that we have to look at, the engineering of the foundation. But again, all of these are the different types of housing. So if you go and start looking online, you may start off thinking it's a house, and you look closer and it's a condominium, or you look and it's like priced right, and then you look a little further, it's a manufactured home. So again, understanding the correlation between those two is great. That's where the realtor comes in, and being able to decipher the benefits of each for you. Any questions on that?
No, looks like we don't have any for now. Go ahead and move on.
Okay, so let's say we've looked at the properties. I think the next thing is that we go ahead and we say, okay, I'm ready to dive in. So hopefully you have an idea of what your maximum is, as I told earlier. And again, that's the strategy. And when you look at your finances and you decide to buy. So what you do is you sit down with the realtor, and hopefully the realtor, if you're looking at a specific property, will give you an idea of what has sold in the neighborhood. And here's where they were listed, and here's what they sold for. Here's kind of the terms associated with the transaction. And so you write up an offer, and you'll say how many days, like a 30-day escrow. And then you submit a price. You tell them roughly what you're willing to put down. So you kind of restate what your pre-approval letter says as far as that goes. And you submit an offer. The offer then goes to the seller's agent. And depending on the market, if it's the current market, in many cases, they may actually leave open a couple days to see how many offers they get. And then they'll counter offer and say, well, we're going to do this. If you ask full price and you're the only one, chances are you're going to get it. If you ask full price and there's 4 other offers, they may counter all 4 offers to come back with the best offer they want to. So then oh, we got to go over the asking price, which is unusual. I mean, that's just kind of in the market here. But so that's a part where you go back and forth. And finally, once if the seller comes back and you're the one that they choose, they accept your offer and you go into escrow. It doesn't mean you're bound to buy the property. It just means you've secured the purchase price. You're putting a down payment, or an earnest money deposit is actually what it is. It's a few $1,000s just to put into escrow to open that up. And then you have contingencies. You have so many days to perform so many different things. Right now, it's like 17 days to get full loan approval, which depending on the property, if you've already been pre-approved, all we're really trying to do is get all the information associated with the property for your review. You want to go and make sure that you do like a physical inspection. You understand what's associated with the property. Does the garbage disposal work? Are all the lights turning on and off? You actually would go through and hire somebody to go and check all of that out. Now, in this market, the seller may say, hey, I'm not fixing anything that you want fixed because I got 5 other people that'll buy it as is. So depending on that, but you as the buyer want to make sure you're aware of what you're purchasing, so that going in what future expenses you may have. Okay, so the garbage disposal doesn't work. Well, I'm going to have to fix that, or there's something associated with this, or some other aspect of the property may not, be fully up to speed with what you want to have. You're not going to be able to go and say, I need all the walls painted, I need this done, because the sellers are pretty much going to laugh at you because they got 5 other people in line that will take it over. So you do that. You then also we have to then get an appraisal to make sure that your property appraises correctly. And I guess I should move on to that. Once the offer is accepted, if it's in escrow, it doesn't mean it's sold. It just means you're moving on to the loan fulfillment part of that. And so you would do a property inspection and termite report. And this, we've seen deals where they waive the termite report, and it's up to you. If you do a termite report, it's on you, meaning that you would have to do anything associated with the termite. Appraisal, we would have to make sure that the property appraises for what you're paying for it by looking at comparable sales. They do a title review to make sure that when you buy the property, there are no other obligations on the property other than the new loan when you buy it, which protects you going forward from any future claims. And then we would finalize the closing costs. That is what's involved in the transaction. Have you asked for anything from the seller? Vice versa. What's the escrow fees? What are the title fees? What are all those other fees? When you get pre-approved, we can give you a rough idea what it's going to cost, but the actual costs are going to be based on the companies that are actually performing those, and there's a variance between those as far as that goes. So once we get the appraisal, the inspection, all of that stuff, we then will submit it to final underwriting for final approval, which is then removing the loan contingency. You move on then to knowing exactly how much cash you need to close, and we will then draw up your final documents. When you actually buy the property, it's sometime after you've signed all your paperwork. It may be the next day, it may be 4 days later, but typically in California, you go to the escrow company, or a notary will come to the house, and you will sign a stack of documents, and then the documents will be taken back to the lender. The lender will sort through all of that. You could then wire or a cashier's check your money to the escrow that you need to contribute to the transaction, and then we fund the loan. And funding the loan then basically puts the money into the escrow. The money is dispersed. The seller gets their money. The closing costs are paid, and you pick up the keys. Now, that whole process is very labor intensive. It's what we spend most of our time doing. But in all of these steps, what we try and do along the way is we try and avoid any surprises. If your income doesn't work right away, I want to know it ahead of time. I don't want to know it when I'm going to close. So having a full review of your income documentation is key. Knowing what everything on your credit report, there's nothing out there. And then, is there anything associated with the property that the seller needs to take care of before that? All of these things are done. We kind of do it as we go to avoid those surprises. Qualifying at the end is the least of, we typically don't have that issue. So knowing that up front is a key. We have a lot of people that get over a barrel because we told them what they qualify for, and they will go and actually spend more money. And then it becomes, hey, I don't know how you have to put more money down. You're going to have to take a different loan. Any of those things, again, those are the things we try and avoid, so that when you go into this transaction, you're fully aware of the high side and the low side of what you're getting into. Now, that's a quick overview, and Natalie, I'll turn it back to you.
Yeah, we do have one more question
Sure.
from Ruby. It's, I am a novice in all of this, but say you get approved for a 550,000 loan, but you find a home at 700,000. Are you bound by the $550,000 loan amount, or are there ways to make up the difference or build your finances to look for the best, highest loan approval amount?
Yes, and yes. You're not bound by anything. The thing that you need to understand is, based on the parameters that you're giving us, we may say this is your maximum. And again, in our pre-approval letter, we're going to tell you two things. We're going to tell you what's the maximum purchase price and the maximum loan associated with it, because those go hand in hand. We calculate the property taxes off of the purchase price. So if there's that much difference, question is, did you ask for us to qualify you at the max, or did you ask us to qualify at the basic? We would then take a look and see, is there any way that we can go higher? Worst cases, we would say, in order to buy the house that you're looking at, you would need to, with the current situation, you would either need to have this much money down, additional money down, or you need to, in some cases, we will add somebody else to the loan in order to qualify. And or you need to go and make more money and before you buy this price of property. So it really depends on the individual. It may be that that's your max, and then it's just a function of, okay, you need to maybe look in a different price range. Challenges, then what can I buy in that price range? So it's not an easy answer, but it doesn't mean you're bound to it. It just means that that may be we can't go above it. But ideally, we're trying to get you approved for the maximum you can qualify, so you know your high end going in.
Okay, great. And then Perla also asked how or what's the best way to find a qualified realtor if looking out of state?
Ooh, that's a great question. I would try and work with a realtor here and see if you can get a referral to another state. In many cases, you may have a franchisee that works here that also works in another state, and they may know. You may contact them to say, hey, do you have any referrals, or can you give me an idea of folks that work in another area? And again, but you have like Berkshire Hathaway. You may have a Berkshire Hathaway in San Diego. You may contact the San Diego office and say, do you guys know of anybody that's in the town or the city that you're looking to buy in? Can you recommend a realtor there? That's where I would start. Or if it's employment wise, again, you may it's just who you know, but I would start there as far as that goes.
Okay, great. Thank you for that answer. It seems as though all of our questions have been answered.
Fantastic. Well, that's what I wanted to cover. Natalie, I think we were going to make information available to them. If there's additional questions, that they can reach out. Obviously, my email, if you want to give them my email, I'm happy to do that. But hopefully this covers, again, a very high level. It's not meant to tell you what you personally qualify for. Just kind of give you a quick overview of the process. So next time you go see a for sale sign, you might remember my conversation.
Okay, great. Thank you so much, Steve, for sharing. We appreciate the information. Next, I'd like to allow my business development colleague, Karen Burke Acosta, to share a few words.
Can you guys hear me? Can you see me? Oh, the video won't come on, but hi, everybody. I'm Karen. Of course, I handle the business relationship between the city of San Diego and California Coast Credit Union. And I'm going to attach my business card here. Hopefully that came. There's the hi, hello. So you guys can contact me if you've got any questions regarding doing a purchase or anything to do with the credit union. I can also help you get your membership so that you can get to Tara Lynn if you want to get some personal hand holding to get you on the right path to getting a mortgage. You can always contact me. I'm a one-stop shop. I do it all. So you've got my contact information. I'd love to hear from you if you've got any questions as well about the process. I'm very knowledgeable on that. Always good to sit in with you, Steve. I always love how you take a complex topic and make it super user-friendly and easy to understand. So thank you for that.
Thanks, Karen.
All right. And then Ruby just asked another question. I don't know if you see Ruby, but if you click on the link in the chat that Karen just dropped in there, she would be happy to help you with that information. If you guys do have any other financial questions, we do have a financial resource that I will put right now into the chat. It answers a bunch of high-level questions covering a bunch of topics. Feel free to peruse that website if you have questions about any financial topics at all. Before we conclude, I'd like to remind you guys all that we will be continuing our monthly webinar series next month on Wednesday, July 20th at noon. The topic will be Making It Last, Retirement Income Strategies for Everyday Investors. You can register for this on the Calcos website at calcoscu.org. If you guys don't have any other questions, or if you guys have any other questions, we will always be available. You can reach out to us at a branch, give us a call, or message us on social media. Our handles are at CalCoastCU. Thank you for joining us today, and I hope everyone has a great rest of their day.
Have a great day, everybody.
See you. Thanks for attending.